Brilliant, brilliant. Many thanks indeed, guys. Many thanks indeed. Right, well, we're just going to look at a knotty little problem this morning, and that knotty little problem is that so often we will look at the pairs. You know, we'll get an idea that we're going to be trading a particular pair, and that's the one that we've got ourselves a little bit possibly fixated on. And what we find is that it doesn't actually do anything, and in fact it probably goes nowhere, and at worst it just does a little chop around and takes out our stop, whilst one of the other pairs, or maybe several other pairs, are absolutely going gangbusters. Now, has that happened to anyone in this room ever? Just a simple Y or N will do. Now, absolutely, indeed. Happens all the time. Well, I say it happens all the time. It happens quite frequently. So there are several ways around the problem. One of them, of course, is to trade everything. You might want to look at, say, 6 or 8 of the majors and put a little bit on everything, and something's going to move somewhere. But of course, that's just the scattergun approach, and you might just as well, drop a pin in a piece of paper to try and sort of do your analysis. So what you want to do is something that's probably just a touch more scientific. So I'm just bear with me for a second. There are 1 or 2 things on this little presentation I just want to run through, but then we'll actually look at the markets and see what's going on this morning, and see if we can just pick out some of those that are good ones to trade, and those that are probably not such good ones to trade. So we're going to be selecting the best trading pair. Now, I guess you know me. We've certainly in the room, we've got a number of people who I have met personally, and of course we have met online a good many times. Breakfast trader, harmonic wave trader, and just about to hit the streets, as it were, is going to be the extreme trader. And the extreme trader is it's a program which is addressing things such as the number of false breakouts that we get, how markets tend to give us a bit of a bum steer so often. And I suppose that's not too dissimilar to what we're looking at this morning. So let's just consider what we want to do. Which pairs to trade? That's the question. First of all, and the very, very first thing, that if we're going to be intraday trading, we want to have enough daily volatility. I mean, it's a given. We've got to have pairs which are actually going to move. So that's number 1. Number 2, we've got to find the right sort of setups and the right patterns that we're looking at to trade. Now, there may be people who are just doing a sort of reasonably straightforward method of trading. They might be Fibonacci traders. They might be moving average people. They might be looking at MACDs. They might be looking at Bollinger Band, all sorts of things. But we've got to just find the patterns that actually work for us. And most importantly, we want nice, clean, tidy, relatively easy to analyze moves. And what we do not want chip, chop, where we've got messy charts just jumping up and down. And as soon as we're sort of trying to get ourselves trading that sort of a chart, then it's not just the charts that chop, chip up and down. It's going to play havoc with our emotions and, our blood pressure, and we're going to get sweaty palms and all that sort of thing. And certainly in my experience, whenever you're sort of getting yourself a little bit sort of wound up and het up about it, then the judgment starts to go awry, and we make mistakes. So, first of all, the ATR. Now, let's just consider the ATR for a moment, the average true range. The average true range, then, of a pair is based on the high and the low, and it's also based on what the last close was. And it's a volatility check, if you like. And we can use it in several different ways. One of them one of the ways in which we can use it to our advantage is that if we come to our desks and we feel that we're going to put on a day trade and we check the ATR, we find that the ATR, the average true range, has been more or less done for the day. Supposing it's gone through, say, around about 100% of an ATR, then what we've got to be a little bit careful of is that will it continue in the same direction? Well, the odds are now going to be very, very much reduced. Or indeed, are we going to trade it against whatever the earlier trend was? Well, in terms of the ATR, then that's probably putting the odds a little further in our favour. Now, we can also use the ATR for stop placement, and we would want to be looking at using, at the very, very least, for a stop, one ATR, at the very, very least. And we can look on it as a sort of statistical measure, or almost. Not quite in the way that you would use a standard deviation, but a very, very similar approach. And some people will actually use 1.5 to 2 ATRs as a stop placement. And, of course, it can show us where there is extreme activity going on. So, that's pretty good. So let's just look at, first of all, then, where we've got volatility. Euro at the moment is running around about 88 pips if we just run this over, say, the last sort of average of 14 days or so. Cable, 100 pips. So, they're very tradable. Euro yen, it starts to increase, 120 odd pips. Again, a very, very good pair to trade intraday. And if we sort of want to then stretch things out, we can look at the pound against Japanese yen. We can look at the euro, AUD, 160 pips. So there are quite a few pairs out there. And, of course, there's a trade-off. Those that have got the greatest ATR quite often will have the greatest volatility. And sometimes too much volatility can be just too much of a good thing. On the other side of that volatility coin, then there's the euro, say, against the British pound. Very, very, very heavily traded. Very heavily traded indeed, particularly in the UK. Spread bet companies do report that they get a lot of trades on this. But it's a little bit limited in what it will do during the day. Checking last week, it was 58 pips is the ATR on it. So possibly better for longer term trades than just trying to sort of catch every little twist and turn on intraday trades. And then you can look at something such as the Euro Swiss, which again at last check was just dropping down to around about 31 odd pips. But as we know, over the last several years, the Swiss have had a big problem with their currency, and there's been a flight to quality. And that flight to quality has meant that the Swiss bank has strengthened considerably. It's caused them all sorts of problems, and consequently they have intervened to keep their currency down. And so it's a manipulated market, and that's one of the reasons why one would want to be very, very cautious about trading the Euro Swiss. Unless, of course, you've got a bit of inside info as to when the next bit of manipulations are coming. Right, now I just mentioned a couple of these ATR-based tools that there are. First of all, then, the one at the bottom of the chart is the ATR stretch. And what is quite useful then, we can see on this particular, it's the euro yen, and there are quite a number of these red spikes. Now, all that is telling us is that these are days when there have been extremes of activity. There's been a lot of activity. So we get these real big days. We look at this little scale on the side there. One is denoting 100% of an ATR. And generally speaking, most of these are fairly well down. Now, we've got just a color coding on here so that once price has whizzed through 140% of an ATR, 140% more, greater than the, or 40% greater than the ATR, then it turns to red. And, there are days, as we can see, when it's more or less got on to double the ATR. But of course, they're few and far between. So if we're looking at a market then that's already gone red, the prospect of that moving in that self-same direction is much diminished because there aren't as many reds as there are blues. Now, the other little volatility measure is one that can be used for stock placement, and this one is called the swing trend. It is based on the ATR, and effectively it follows price, but this one is set for 1.5 times the ATR. So if price then were to correct back more than 1.5 times an ATR, then there'll be a little alert and that would get one out of the trade. So you've got a couple of little volatility measures there. Now, both of those are available to Traders Class members, so I'll just give a little plug on that. But it's a very useful little tool, and just sort of monitoring that is quite a useful little exercise just in itself. Right, now let's just look at a morning routine, day traders' morning routine. First of all, I take a glance at this little lot. What we've got are the majors. So we've got the euro, we've got cable, etc., and the Aussie. Euro GBP, I've mentioned, which occasionally I will put on a swing trade on it. And we've got the CAD, we've got the Jappy, some of the Jappy crosses on here. And we've got the likes of gold and the stock market and the dollar index. So just a little snapshot of what is going on. And all of these are 4-hour charts. So each individual candle, each bar is 240 minutes. I actually find that this is one of the most useful charts to look at. And the reason for that is that we quite often will see areas of consolidation, and we will then see price moving out of those areas of consolidation. And that's what I'm looking for. I'm looking for areas of consolidation. Now, I can't actually blow this chart up in a minute until we get to the real charts. But if we just look at the one over here, which is this middle row, second one in from the left, and it's the USD JPY. It's the Jappy. What am I looking for? Right, well, if we look down at the bottom here, we've got price which has been moving down, using the usual sort of zigzag move down. But then it's reached an extreme. And we can tell that it's reached an extreme for just looking at how the candle is formed. So we've got a little spinning candle where we've got a fairly long lower wick, lower tail, small body. But then after that, we get a little Hallmey, so that's indecision. And lo and behold, what happens then? It bounces on up. So that is suggesting that just maybe this previous downtrend has come to an end and we could be on for a move up. And that's exactly what did happen. Now, I don't generally actually trade off the 240-minute chart, but this is all part of my analysis. I want to be looking at it. If we just follow this on through, then it came to an end. There was actually a fib level picked up there, 100% of the move. Then it came down, popped back up for a retrace. And by just doing a little straightforward candle analysis, we can just look at those and think, right, okay, well, maybe this down move has come to an end and we're ready for an up move. Could there be a trade to be taken on the intraday charts? So that's how the thinking goes. And this is just a daily thing. I will look at this. I'll come back to it during the day if maybe I haven't got a trade on, or if I've got trades on, I'd just be looking at how the overall picture is developing. And if there are any main things developing, such as, has the dollar index suddenly taken off? Have we seen sort of a major move in gold? If that is the case, how could that be impacting some of the other currencies? So there we are. That's a real plug for the 4-hour chart. It's the one not to be missed. Really, really quite useful. So let's just then, I'll just annotate this as I have. And this is how that thinking goes. You know, downtrends developing, got sort of several over here, got the euro, which decided to take a tumble when I did that particular chart. Cable there is just sort of meandering lower. What's going on with the Australian? Well, it's moved into downtrend move. What about uptrends? What about the opposite? Well, we would expect that the USD pairs, those with this being the primary part of the pair, are going to be doing exactly the opposite. And sure enough, we can see in the Swiss we've got uptrends developing, the dollar index uptrend developing. And then what about topping price action? Well, topping price action there on the ES, although it did subsequently go higher after that, and some topping action on gold, topping action on the CAD, the loonie, etc. So there we are. That's the 240-minute chart. So let's bring this right the way down to a 5-minute chart right now. And what I'm looking at here, I am looking at what is just going on with a very, very simple little color change trend indicator. But let's just look at what is going on. First of all, the mere fact that I'm looking at this, and there was clearly a little bit of news out at that particular time, and it's caused a fair degree of whipsaw. I do not want to get involved in whipsawing markets. Whipsawing markets are painful in so many ways. Want to just keep out of them. So consequently, I'm going to keep an eye on, when is the news? So what about this one? Well, this one is a nice, clean and tidy move. It formed a low, a higher low. We get a nice little correction back, a higher low. At the moment, it's just under this little color average. Price then pops above, and lo and behold, it finds support in the region of that average. Another higher low. Can't quite manage to go higher. Finds support yet again. That is a thing of beauty. That chart is developing very, very, very nicely, and it then just takes off from that area, pushes on up, and eventually comes to an end and moves into a downtrend. So for the intraday trader, there's plenty of movement to be had out of that one, for a very reasonable number of pips to be had there on the way up. Now, if we look at the euro yen and the USD JPY, then we've got quite a reasonable move. Again, just bouncing off this area of the color average, doing all the right things. It's got all the right candles, and it's moving up with these real thrusting moves, and eventually that comes to an end. So a nice, clean and tidy move. Now, not quite so clean and tidy as the Australian over on the right, but it does do the right things. We've got the swing trend on this one, just showing how, by sort of using this for stop placement, I can just follow a trend on down on the color change and just stay with it until it actually breaks on up through with the close. So there we are. That's going right the way down to that 5-minute chart. What we so want to avoid is this. Now, I mentioned the Euro Swiss, which at the moment, or at least recently, has been in sort of go nowhere direction. And, what about that? Trying to catch a trade here is like trying to catch a hopping frog. You've got to be real quick. And by the time you actually grab it, the thing's just going to jump out of your fingers. It's slippery and slimy and has jumped out. And, you could draw that analogy that by trying to catch these little changes in direction, they're just too small they're just too small to actually make any money. The only person who's going to make any money about trying to trade this little lot is going to be your broker or spread betting company. They would love it if you traded this, absolutely love it, because you'll be in and out, in and out, in and out, in and out, and they'll be taking money off you on the majority of those trades. So where you've got something which is just not developing anything clearly at all, we've got the swing trend on there, we can see that that's chopping one way then the other, and it's going to cause us all sorts of problems. So I suppose one of my messages is that if you're looking at your charts and all you can see are charts which are rather like this, then just do nothing. Don't even attempt to get on board. Don't even bother with it. Just leave it to one side and come back another day or later in the day, or just wait and be patient. Because eventually, the right sort of things will turn up. Now, I did just mention the news, and what we always need to be alive to is when there is going to be news. So, frequently in the morning, 8 o'clock, we get a red there, the French flash manufacturing. Things in red, as we know, are likely to be market-moving events. And what I always try to avoid is actually putting a trade on during the time of an announcement. Never want to do that. Always want to be aware of the fact of the times when something is likely to be announced. Now, we occasionally will get things which come out of the blue, such as Mario Draghi just might come up with, there might be a press conference. Okay, usually we know when the press conferences are, but sometimes when there's a meeting, they'll just sort of nip out and make some comment. We don't know when that time is going to be. And so we can quite often get ourselves a little bit caught out. So you just need to be aware of when that is likely to be. And the general rule, as we'll see in this chart in a minute, is to get placed either well before or after the news, once the market has settled into whatever it's going to do. But actually trading on the news announcements themselves is a difficult game. So we've got to know when it's due. And what we want to do is make sure we do not get involved in this sort of spiky behavior, because, where is it really going? We don't know. We don't know. It started off with a big move higher, then it thumped down, then it attempted to go higher, then it thumped down again. And what eventually happened was this. So if we just sort of sit through this, sit in the hands, don't do anything, but then we just wait and see what is really developing. And that move on the left developed into this one. Now it's relatively spiky, but the trend did run really quite consistently and developed into quite a lot of pips. Right, okay guys. Well, we're going to look at some charts right now, so if you can bear with me. Well, I will just mention that Traders Class members actually get those two at the ATR stretch and, of course, the swing trend absolutely free. Right, now bear with me, half a mo, and let's see if we can find the charts. There we go. Right, can you see those all right? Sometimes when we switch over, it doesn't actually present correctly. Right, okay. So, what we're looking at right now then, we're just taking a quick glance at cable. Now, cable has been flavour of the month. Been flavour of the month for about a month, where we actually have this interesting move up from just above 162 and following good old traditions of support and resistance, where we've got a support level which was previously resistance, and it formed a very neat little consolidation. And coming out of that consolidation, price then moved on. And it moved on into a beautiful little trend. And I guess that a number of people in this room have managed to catch that trend, and it worked very nicely. We come down to the 4-hour chart. What we can see over here on the left is a very clear area of that low. And price had quite previously then been coming on down, and it came down to that level as an extreme. We can see it's an extreme. Just eyeball the fact that it's moved on down and down and down. We can see that the value finder has told us that it was at an extreme. And then we get a nice little bit of price action, which becomes very, very clear on the 4-hour chart. So we've got a low with one of these big, big engulfing candles. But price then came down to test it. It did. It dropped down just a little bit below it, but then it moved on up. And finally, we get the all-important higher low, and it absolutely took off. So the 4-hour chart, all important, and it developed into a pretty clean and tidy move that then allowed it to move on up. But we will quite often move from a very, very nice, clean and tidy move that allows us on more or less each of these days to get some real good intraday, clean, tidy moves. But then, after the peak, after the extreme peak, we got the sort of fib finder picking out the peak for us, and also the value finder just telling us that, you know, it's all over now on the upside. We then drop into a whole series of days of chip, chop, chip. And there was a classic day in this one. Up, down, up. And they're the days that we've got to be so careful that all of the gains that we've tucked away on those big, clean, tidy, nice running days is not all given back over probably the same sort of length of time, like chip, chop, chip, and by the time it turns and gets ready to move on again, we've actually given back all of those gains and sometimes more. So we've got to be exceedingly cautious to be very circumspect, make sure that our money management is set in such a way that we do not allow ourselves to give back big lumps of gains that we may well have tucked away. And consequently, we've just got to be patient and wait for the right move. So really, if we just take from about the 18th through until late on the 24th, most of those days were not the easiest of days to trade. And so we would need to be pretty cautious on those days. Now let's just look at, bear with me half a moment. Just run back through this is really what I wanted to look at on this 60-minute chart. And we've got a whole series of fibs picking up and picks out the various levels. I'll just knock that off for a moment. So that we've got a somewhat clearer chart. There absolutely were opportunities. And we can do some very straightforward stuff where we could pick out highs and lows, where we find that clearly we're starting at the the left-hand edge of this particular lot, we can actually see that there are areas where we should be looking to short and areas where we should be looking to buy. Now, provided that this range is wide enough, and this one was to be around about sort of 80 to 100 pips, then we can get involved in dealing with some of these spiky charts. But the range has got to be sufficient for us to be able to get in and get out and not be concerned about whatever spread that we're paying. So if we can just sort of come back to the basics of looking at technical analysis with support and resistance, we can see an area here where price then has popped up to several times. And if it pops up there at some point in the future, as it did just here, then we can look at that and think, well, that's now popped up to an extreme. Could it be an opportunity? And consequently, we'll then go down to look at the small time frames, going right the way down to the 5 and the 15-minute chart to see if we can actually get something on in that level. So, I suppose my message then really is that pick something that's got sufficient ATR in it. Look at the 240-minute charts to see where there are consolidation areas and zones, and price could actually potentially move into a trend from those zones. And then come right the way down to things like the 5-minute chart, the 15-minute chart, to look at the opportunities that just might have developed. Now, if we come right the way down then to the 5-minute this morning on cable, then what we've actually got is a beautiful little move. Now, one of the earlier moves was a little bit too early for me. We've got higher lows, we've got higher highs, start to move on up. We've got a whole series of averages here that are moving in the right direction. And there was a little news announcement that came through at that time and kicked this move on. But by the time UK traders actually get to their desks, they can actually see that there's a pretty neat little consolidation going on. And that little neat consolidation took place, and that was a flag, and price just broke out of it beautifully. We get another little breakout here with not a massive, but a very acceptable little run of 25 to 30 pips that could be taken quite happily whilst the longer term charts just sort themselves out. So intraday traders, picking the right pairs, can do quite nicely out of some of these moves. Right, now, bear with me half a mo. Quite a lot of uncertainty. This real neat, tidy uptrend from September, downtrend that ran from the end of October to more or less the end of the year. Beautiful trends, very clean, very tidy, very straightforward. Every time it bounces back, there's an opportunity there to get in on the trend. That then developed into this sideways price action that we've really seen for the first couple of months of this year. And that sideways price action can be really rather frustrating. So, what is the reason for this sideways price action? Well, there are two reasons. One of them is that the Commitment of Traders report has shown that after this big downtrend, the number of shorts in the market are massive. Massive number of shorts. Okay? And after a big move down, you so often get that. Most traders get it wrong, tend to be on the wrong side of the market at the wrong time. And that's certainly the case. So during the formation of this bottom, which may be a bottom, we don't know, then we've got a massive number of short positions. But also, at the same time, we've got the talking heads coming out of the IMF, Christine Lagarde in particular, telling us that the right level for the Australian dollar is closer to 80 than it is 90. So we got a cross current there. We've got those who are going to look at the fundamental position, can actually see that the true fundamental position of market participants, not of the economy, forget the economy, but of the market participants, is that they're positioned short. And just maybe there are too many of them positioned short for this move to continue on down because there's nobody left to sell it. Then you've got Christine Lagarde saying that this currency is going to go lower and should be lower. So you've got a conflict of analysis, if you like. And consequently, that's what we've got right now. We've got a conflicting analysis going on, and that's why this whole pattern is now starting to look like a reverse head and shoulders. Now, quite who's going to win this battle? Well, we've got to wait and see on that one. But one of the most important things to do is to look at the Commitment of Traders report and just look at the number of short positions. And what we'll see is that the longer it stays in this trading range, just going sideways, is that those short positions will gradually get themselves unwound and will set themselves up into a position where it's relatively neutral. And once it's relatively neutral, then we can look for a real good move. So there we are. Longer term trade wise, one just to stand aside from at the moment. But intraday trade wise, then plenty of opportunities to be had as we get these little moves, which we can see on the 240-minute charts, and just look at the fib levels, look at the Gartleys, where we get price sort of moving on up to a Gartley level, and then it moves on down, comes down to the important level that we found yesterday, just popped down to a level, whole series of fibs and harmonics coming to that level and creating an opportunity. And that opportunity actually came last night from, again, a whole load of conflict that came out of the standard announcement, interest rate announcement, which was to keep interest rates where they were. But of course, the various comments that came with it meant that we've got a fair bit of whipsawing. Now, you could argue that this is not the cleanest and the tidiest chart in the world, but that, after the news announcement, it did then develop into quite a reasonable trend moving on up. But overall, it's one to be exceedingly cautious of until that big short position gets itself unwound. Right, guys. Well, I've covered all of the ground that I wanted to cover this morning. And if you've got any questions or any charts you'd like us just to take a little glance at, then do fire away right now. But otherwise, let's just take a little glance at the euro for a moment, because the euro potentially has created something of a sea change in that we had a move that ran on down, rather like cattle. We've got it on the over not quite a week. We get a consolidation area, which really showed up very, very nicely on the 240-minute chart. And then we have the price moved up, spiked down. Price moved up, spiked down, and then moved up again. We look at that on the 240. We can see some real quite interesting areas. And these areas, that was that consolidation lasting several days. Price then eventually resolved on the upside. Notice the spike that ran on down, went down to that level. But get these big sell-offs followed by a big rally up. We get a big sell-off followed by a big rally up to a new high. So the question now is what happens next. We've had a gap down, and we can look on this as being an ABC type measured move. Will it or will it not manage to get above this area, okay, of resistance? Look at that for an almost perfect area of higher highs providing resistance, and it has done that today, this morning. Will it find sufficient support in order to fuel the next big run up? Now that is the question. Talking of trading ranges, we put another line across, and that line is picking up a series of areas which have been resistance, resistance, resistance. Eventually there are enough buyers to push it above. Support, support, resistance. Resistance just stepped to one side as it pushed on up through, and then support. So that's the band at the moment. That is the band, which is really only about, it's not even quite 50 odd pips. But that's where the euro is going to need to move itself out of for us then to get the next decent run. Right, guys, I'm going to come to an end at that point. Many thanks for being with me this morning. I hope you've found that useful. Don't hesitate to get in touch, and if you have not already got the free ebook, then head on over to tradersclass.net and make sure you just get signed up for that free ebook.